Hello, one rental at a time nation. Today is Sunday, the day before St. Patty's Day. So I hope everyone has a fun St. Patrick's Day tomorrow when everyone is Irish. I am sitting in here today. Mike Zuber, I don't think is back yet. He might be on a plane or red eye on the way. I think his cruise is finished up in Osaka, Japan, and should be back, I don't know, later today or maybe tomorrow. But at any rate, I thought I would just do a quick video just to get everyone up to date on the market and set the stage for what's coming next week. Next week is options expiration. And as usual, Max Payne, I will do a Max Payne video on my YouTube channel. I'll show you that in a minute for those that are interested. But I will, if I get the report tomorrow, Monday, I'll do it on Monday evening. And I'll show you what Max Payne looks like for next week. I expect that the market's going to rally. I think it started on Friday. Actually, there was some hints of it on Thursday, but I think it did start Friday. I think it's going to continue. I think we have the Fed meeting next week. I don't think they're going to do anything. There's not really any reason for them to. I'll show you why in a minute. So I think overall the market is ready to move higher. It's very oversold. And there are some signs that Wall Street is positioning for a rally, at least in the short term. So I think it probably will be a couple of weeks worth of a rally. Then we'll see what happens. I'll show you what 2022 looked like, just so that everyone is prepared for what might happen. So let's take a look at what I'm talking about. This is my website for anyone interested, breakpointtrading.net. The YouTube channel is right. My YouTube channel is right here in the upper right. Unfortunately, we can't put links in the YouTube, so they just get deleted. So don't ask to put the link in there. But if you're interested in the YouTube channel, just click on that. It will take you over here. This is my YouTube channel, Breakpoint Trading. And notice we have 987 subscribers. So let's see if we can get to 1,000, maybe before Mr. Zuber comes back on the air sometime this week. If you're interested, please go over and check it out. Please subscribe once you're there, and let's see if we can't make it up over 1,000. But there's also in the channel, there is a playlist, and the playlist is made up of basically training. I call it Technical Tuesday, so every Tuesday I cover a particular technical indicator and other topics sometimes as well. This coming Tuesday, I'm going to talk about risk management and position sizing and how you can lower your risk by using a risk calculator that I created. I also did one on Bitcoin, which you might find really interesting for anyone that doesn't understand Bitcoin. That one will help you to understand what Bitcoin's all about. That's in the Technical Tuesday playlist. That was done back in near Christmas, so it has a picture of Santa Claus on it. It's an easy way to find it. Anyway, let's take a look at what happened this week in the market. You can see my market bias is still heading down, but interestingly on Friday, it did not add or subtract. There were no bulls and no bears at all on Friday. So it just went sideways a little bit. Again, I think it's poised for a rally. Here's the S&P. You'll see pretty quickly that it is just beginning to move higher right there. So the S&P, usually the big, huge sell-off, it's below the 50, below the 21, below the 200. So I think personally, I think it's going to come back somewhere in the middle of the 21 and the 50, which would be about 58.50, which I talked about before was the line in the sand for this distribution phase. I'll show you that in a minute too. So that's where I think it'll come back to. That's where we need to watch if it does. If it rallies back to that point, we need to really pay attention. And if it can't get through the 50 and turns around and starts lower, then it probably will go even lower than this one. But that does not mean it will. So we just have to keep an eye on it. The NASDAQ 100, very similar. You can see it also had a little rally on Friday. I think it's going to also come back to the same area. It'll revert to the mean and then blow through the mean, but probably won't get through the 50-day. Might get rejected there at the 50-day. So something we'll watch. We'll continue to watch it on my channel. We'll watch it on this one each Sunday with Mr. Zuber. which I assume he'll be back next week. One thing let's look at Bitcoin before I go any further, because I know there's Bitcoin folks out there that are interested. So Bitcoin actually went, Bitcoin's open 24/7. So this reflects even the weekend. But on Friday, it actually went up a little bit, was up slightly on Friday, not as much as the rest of the market, which was a little concerning. I added a line down here for MicroStrategy, or now called Strategy, MSTR. So that's the symbol for Michael Saylor's stock. Again, you can see that it ended on Friday where Bitcoin didn't. So this is the Friday candle that actually had a bullish engulfing candle on Friday. I mentioned this on my channel. So that is a very bullish candle. But then on Saturday, didn't do much. And today it's pulling back a little bit, but there's not much volume on the weekend. So those two don't really mean that much. We'll see what happens when we open on Monday. I expect Bitcoin will probably rally along with the rest of the market. A couple of things that I added is the new Dow theory. If you click here, those that are not subscribers will at least get an education on what Dow theory is, because you don't need to subscribe to get to this part of it. And down below, it has a chart of Dow theory, which is the Dow industrials versus transportation. Charles Dow created the industrials back in the turn of the century of 1900, turn of the last century, I should say. And he postulated that the people that produce the goods, the industrials, and the people that ship the goods, the transportation index, if the market is moving higher, that they should both be in sync. And if one of them, in particular transportation, is not moving at the same pace as industrials, then the rally or the uptrend or the bullish phase is in jeopardy. So what you can see here, I drew a line across the tops, and the vertical blue lines are the same date on both these charts. So you can see the transportation average right there came up, went down, and came right back to the same level. However, I'm sorry, the industrials came back to the same level. However, transportation did not. Transportation was lower. So that is non-confirming the rally. Means the market probably is going to roll over. And this was back in the end of January, beginning part of February. And that's exactly what happened. The market rolled over. So what I created is three other ones that are more reflective of today's environment. I'll show you one of them, which is the equal weight, but I also did the same thing with the NASDAQ 100 cap weighted versus semiconductors and communication services versus the internet group. So for those that are subscribers, you will have access to all three of these charts, but just to give you an idea of what the equal weighted look like. And I use equal weighted because it levels the playing field of the big cap tech stocks, which make up more than 50% of the triple Qs. Only 10 stocks make up more than 50% of this ETF right here. So I wanted to put in equal weighted to level the playing field. So you can see in February, the equal weight NASDAQ made a new high. However, the equal weight S&P did not. So this is the new Dow theory now telling us that the market is rolling over. And same thing happened with the other two. Those charts are right in here for those that are interested. Back on the homepage, just real quick, I've talked about the secular bull market before, and it is still in force. The secular bull market typically lasts 18 to 20 years, probably should go till 2029 to 2033. So even if we have a pullback, and I know a lot of people are saying that this is going to be a huge crash. However, interestingly, over the weekend and even the end of last week, a lot of the people that I follow are now saying that we are going to have a rally. There's different opinions on how long that rally might last, but pretty much everyone I've listened to also believe that there'll be a rally next week. And I think there will as well. So what does that mean for this long-term secular bull? Is it in jeopardy? Well, first of all, it's making lower highs on the momentum chart, even as the price makes higher highs. So that implies that it's running out of steam. But this is a monthly chart, and this could take a long time for that to happen. And you notice what happened here in 2022. where it went down right down to this line, the same place as it went to before during the secular bull market, and it never went below it, even in 22. So momentum came down in 22, just like it's doing now, just beginning to do now. And it came back, the price came back and hit the 200-week moving average, but did not go below it. And that's what it looks like we're going to do this time as well. So I think it's going to look similar to 22. But I don't think the secular bull is over yet. I think we will take it out to this period out here. Interestingly, 2029 is the 100-year anniversary of the 1929 crash. So maybe markets like to be symmetrical. All right, so other thing that I added on here that's really interesting is I talked before about the bottom finders that I created. So I'll look at it for the NASDAQ 100 because it's real easy to figure it out. So here's the NASDAQ 100, and the bottom finder basically shows percent of stocks above their 20-day moving average, their 50-day moving average, and their 200-day moving average. And what you can see, and you can see the little rally on Friday that I think is going to continue probably up into this area. But on Thursday last week, you can see that the percentage of stocks above their 20-day was below 10. It got down to 9%. Right now it's at 19%, but it's still below 20. But at 9% or even at 10, that means that 10 out of 100 stocks, only 10 were above their 20-day. If we look at the 50-day, the key level I look at for that is 20%, and it did not get to 20. It's at 27 right now. It got down to about 22 or 23. So 23 stocks out of 100 were above their 50-day. And on the 200-day, the key level for me is the 30% level. It got down to about 35%. Right now it's at 42. So these went down pretty substantially, close to an area where the bottoms are made. And it's certainly at this particular stage an area where a rally could absolutely occur. So that's one of the reasons I think that a rally might be in store. The VIX also is moving back down. It is not yet below 20. But if we do get more of a rally on Monday, this will probably start going below 20 as well. And the put-call ratio, which had been moving up, meaning more puts, more people were bearish, moved sideways on Friday. So that doesn't mean people are buying more calls yet, but they're maybe not buying puts anymore. So that is another sign of a potential rally. But notice that the bottom doesn't happen until it gets way up here above 72, way back in these levels over here. And it's not close to that yet. And these up here are not really at the levels that they could be for a real bottom. So even though we're going to get a rally, I believe the rally will be temporary. And by that, I mean maybe 2 weeks or so. We have the Fed meeting next week, which I don't think they're going to do anything. Interestingly, and I heard this from someone else that I listened to, I'll show you another quote from him in a minute. Larry Williams, who's a contributor on stockcharts.com and is well known as a technical analyst. He's actually created a number of indicators himself. But one of the things that he said was one of the catalysts that might propel the market quite a bit higher or really stoke the rally is the Ukraine war coming to an end. And he thinks that could happen pretty soon in the near term. And when he mentioned that, I thought that's probably will help the market to move higher if that happens. That kind of news usually is temporary, but it will be a catalyst, especially as oversold as we are right now. So there's a lot of people just looking for an excuse to jump back in and buy. And if there's signs that a end to the war is in store, then that certainly will stoke a rally. So I thought that was an interesting comment. So we'll keep an eye on that. Take a look at it. So let's take a look. So now you've seen the bottom finder for where we are right now. What did this look like in 2022? Well, I created a chart for 2022 with the same indicators on it. And what you'll see is back here in January is when the signs were that the market was rolling. The signs actually were even before that. I started doing my show here on the one rental at a time channel back in December with Mr. Zuber in 2021. And I showed the reasons why the market would likely be going lower for most of the year, way back here. And in January is when it started going down. And notice where the 20-day didn't have a chart yet, but the 50-day you can see was below 20, certainly. And it continued below 20 until we got a rally right here, back up to the 200-day. And that one rallied, and then it pulled back again as the market pulled back. So the market pulled back to a lower low, and the percentage of stocks above the 50 hit a lower low as well. In fact, they hit about 9%. That's a lot for the 50-day moving average. And then it rallied again a little bit, but couldn't make it nearly back to where it was before, and then rolled over again. And lots of people were saying in June that that was the bottom. And you can see certainly the 50-day was way, way down there, lower than it had been all through this period. 200-day now was way lower. It was below its 10 also. So everything was low. The VIX was way, way above. And the put-call ratio was above the 72 line right there. Look where it got to, though, as the market continued to sell off. All right, so then we went along, and everyone thought that was the bottom, and started into a huge rally, but again, could not get through the 200. But right at this point right here is when Jerome Powell came out with his famous speech about more pain ahead, Jackson Hole speech. And as soon as he came out with that speech, the market started selling off again. You can see what happened with the number percent above the 20, percent above the 50, percent above the 200. They all went down and actually made even lower points than they had before. And then it started to recover. Now, the actual low was here in October, even though the low on the 50 was before that, was back in September. But notice what's happened when we hit the low in October. The percentage of stocks above their 50 was moving up. So Wall Street was starting to take positions. They were starting to buy some names that had been sold off so much through this whole year period, almost a year. And that was reflected right here as this line started to move up, as more and more stocks were, their percentage of stocks were above their 50-day moving average, even as the market hit new lows. So that was the indication that that really probably was the low. And then we started to make higher lows after that. So that's what we want to watch. I think this year might look similar to this. We need to be careful. I think we probably are right here, similar to where we are right now. We're right at this stage. So this started in January. We now started around the middle of February. So we're about 5 weeks behind the 2022 chart. So this rally right here was right at the end of January. We're doing it right in the middle of March. So if we do get a little rally like this, that's what I think is going to happen. Then we're going to have another sell-off. But we'll see. We'll see how many catalysts we can get. I think the next CPI number is going to, next two CPI numbers are going to be positive. So inflation will continue to go lower. Here's CPI. On my YouTube channel last week before CPI came out, I said that the projection was for 2.9. It was 3 last month. I said we're likely going to hit 2.8, and that's exactly what we hit. And the reason was because there was a big one dropping off just from the data. There was a big one dropping off in this report that just came out. And when that happens, it makes the new number that gets added in, it's based on a 12-month moving window. It helps that to go down. We have another big one, and we have 2 more big ones that drop off in the next 2 months. So as long as commodities and oil in particular either stays where it is or goes down some more, then we will get another drop, 2 more drops in the CPI, and the inflation rate will look like it's coming down. We could easily get below 2.5. But then look what happens here in the summertime. We actually have a negative one right there. So in the summertime, we've got 1, 2 really small ones. So this will be the June and the July reports. So they are going to look like inflation's going back up again. And everyone, all the news you'll see will start talking about inflation is back. The tariffs are causing it. They're not. And there's a little bit bigger one in, so this is June, July, and August, summer months. So the summer months are going to be choppy, I think. So we might get this rally, until we get to probably the June timeframe. The rally could really even last right through April. And then we have to be really careful what happens during this period right here. All right. That's what I want to show you here. I want to finish up with some slides and talk about a couple of things. So the first thing I want to talk about is I want to remind everyone of how the market versus the economy works. So markets are usually 6 to 9 months ahead of the economy. Another way to think of that is the stock market is about 6 months ahead of the mainstream media news. So when you start hearing on the news about a recession, that a recession is in progress, oops, let me get back to that, then the market has already priced that in and the market is already recovering, has already bottomed. And there is talk right now about recession, and I think we're going to get a rally. So we're about 6 months ahead of the market. Just always remember that. If you hear something on the news, on the main news, and even CNBC for that matter, always think to yourself that you've already missed it from the stock market perspective. So you have to be thinking ahead all the time. The next chart is the distribution phase that I mentioned before, and I've talked about here quite a few times. This down here is the chart or the image of the market cycles. This comes directly from Dow theory as well. It's another component of Dow theory versus what I showed you before with industrials versus transportation, but this is also Dow theory, where Dow said that markets move in particular phases or cycles. There's an accumulation phase at the bottom. Then there's a participation phase or a markup phase as the market moves higher. Then there is a euphoria phase where retail traders are buying. There's a distribution phase where Wall Street is selling to retail traders. And then it breaks out of this sideways channel and the distribution phase ends. And then the markdown phase begins. And the markdown phase then continues until we get to the bottom and another accumulation phase starts. So the chart on the top is updated as of Friday. So that little bar right there, that blue one, is Friday's close. So this is all the way back from October of 23 when this bull market began. So and this is the whole, you can see the markup phase. There's a reaccumulation phase right here. There's another one up here. And then we get to the top and we started bouncing up and down. You can see where this particular one goes a little bit lower than the other two. That's this one right here. So it went lower than these, but then it bounced back up, went back to the top, and we made 3 consecutive all-time highs before it rolled over in the middle of February and broke through the bottom of this channel line, and we started into a markdown phase. And the markdown phase, I think where we are right now, is at this particular bottom part where it bounced and rallied back up to the bottom of this, what was support and now resistance. So that would be this line right here at 58.50. So I'm expecting to see a rally back up to that level. That's between the 200 and the 50-day, just like I mentioned before. And then we have to watch, because it doesn't mean it will do this. It means this is what has typically happened, how markets usually work. But it can do anything it wants. But watch what happens when it gets to 58.50. If it cannot break through that, especially with volume, then and it turns around and starts to head lower, then we likely are going down to a lower low than we had back here. So that's what that looks like. That it looks eerily similar to what our current market looks like. And this is something that Dow came up with 125 years ago. So keep that in mind. Now, if we look at Stock Traders Almanac, and this is the historical view back 75 years, what the market has typically done, you can see the inflation report right here came out, and the market went sideways until Friday. So here's Friday the 14th, and here's tomorrow. That's where you are right now. Notice what happens starting tomorrow. This is where the bottom for March comes in. And from Tomorrow, St. Patrick's Day, which historically is a bullish day in general, the market starts to rally, and it rallies all the way into the end of the month. And then next, when the April one comes out, then I'll show you that one as well. But this all comes from Stock Traders Almanac. So we've got the Fed meeting next week on the 19th, and we've got options expiration on the 21st. I'm going to do Max Payne probably on Monday, but I'm expecting it to show a rally also into the end of the week, and then perhaps even continuing higher. So that's what that looks like. It's very, very much in keeping with what all the other traders and folks on YouTube that are talking about. All right, the next thing I'm going to talk about is tariffs, and I've heard a lot of comments about tariffs being inflationary. Tariffs are not inflationary. Printing money is inflationary. That's what Biden did. Tariffs are not inflationary. I saw something on the news where they were at a wine and beer shop, and they were talking about the tariffs on European wines. And a lot of the people out front were concerned. They're saying, well, we're going to end up paying more, so our prices are going up. You know, they're putting these tariffs on wine, so European wines, so our prices are going up. I did not hear one reporter ask them, why wouldn't you buy American wines instead? They're just as good. Wines coming out of Napa these days are just as good as European wines. And if they're cheaper than European wines, then why not just buy American wines? And that's why tariffs are not inflationary. They cause you to make different choices and choose different things to buy, certainly, but they are not inflationary. So I'm going to show you next a chart that I found that's very interesting, and a comment that I also heard that was, I thought, very insightful. So this is the chart on tariffs. This is the current status of tariffs. This is as of 2024. It's from the Department of Commerce. And the comment that I heard was, we're not starting a trade war. The trade war has been in progress for decades, but for the first time, we're shooting back. And I thought that was a great way to explain what's happening. The trade war has been going on for a long, long time. It's hasn't just started just because Trump is in office. Trade war has already been going, and it's been getting worse every year, by the way. So, but for the first time, we're starting to shoot back. So here's the European Union. This is the purple is imports, and the red are exports. So you can see that the imbalance. Europe imports a lot more U.S. goods than they export to us. They charge us tariffs as a result, much higher than our tariffs, by the way. So the tariffs that we're projecting to levy on them basically just levels the playing field. It makes things equal. But the European Union, we have a deficit of minus 236 billion, Mexico minus 172 billion, Canada minus 63 billion, China minus 295 billion. Those are the four biggest ones that are charging us a lot more tariffs than we charge them. So keep that in mind whenever you hear this talk about tariffs. This is not something new. It's back before there was an income tax, by the way, before 1913 when the income tax was created. You know how the U.S. government made its money? By tariffs. That's the way the U.S. government collected money, by charging tariffs. So keep that in mind next time you look at something like this. Now, the next one is a quote from Larry Williams, who I talked about before, and he's the one that mentioned that it could be the end of the Ukraine war. That could be the catalyst. But this was the last slide in his presentation. It's and this is his view, of course, his opinion. Globalization is falling apart. Tariffs may increase prices, but they will increase jobs. And that's what tariffs do. They incent companies from overseas to build plants in the US instead of building them somewhere else. And that employs US workers and creates more jobs. So I think Larry was absolutely correct tariffs may increase prices, and I just gave you an example. They may increase prices on European wine, but you have other choices that are just as good and are cheaper. So you can make those other choices. And then drill, baby, drill will lower inflation by creating more oil. Oil is the number one, one of the number one reasons why inflation goes up. So by creating more oil, that will lower inflation as well. So here's a couple of headlines that I found. Honda will manufacture next generation Civic in Indiana instead of Mexico. So it was planning to build its plant in Mexico, but because of the tariffs, it's now planning to build the plant in the United States. That's what tariffs do. They create more jobs. Here's another one. Taiwan Semiconductor will boost U.S. expansion to invest $100 billion over the next 4 years. And you're going to start seeing this over and over with companies that may have thought about building their plants in Mexico or offshore somewhere else, now deciding, and this happened many years ago as well, when Toyota decided to start building its plants in South Carolina instead of in China or in Japan, building them in Japan. Because of tariffs, it was cheaper for them to make the cars here, which employed US workers. So remember that whenever somebody talks about tariffs, that it actually will increase jobs, will create jobs in the US. All right, that's it for today. If anyone's interested, breakpointtrading.net. My newsletter is right here. It's free. Don't need a subscription for that. I put that out every week. It has a lot of similar information in there and a lot of interesting charts, some that I pull from other people and I just post on there just for your information. So thanks for joining. Please, for anyone that's interested in my YouTube channel, we are still at 987, I think. Let me refresh and see what it says. Yeah, still at 987. We just need 13 more. So go ahead and log in over there. I post this every day, so I'll give you an update every day on what the market's looking like. All right, thanks everyone. Thanks for listening. Stay safe out there. Mr. Zuber will be back. He's already been doing his real estate shows from Shipboard, as you probably know. But he'll be back full force next week, I think. I'm pretty sure. Maybe Monday. And then him and I hopefully will talk again together next Sunday. So thanks for joining, and I will talk to you later. Take care.